Hey everyone, and welcome to today's Global Market Explainer. If you're tuning in, you're obviously a focused learner looking to cut right through the noise and figure out exactly what's driving the financial world right now. I'm absolutely thrilled to be your guide on this cinematic trip across the global markets at the close of July 2026. We've got a ton of fascinating data to cover, so let's jump right in and build a crystal clear picture of the global economy.
Okay, let's dive into this right away. A massive wall of green is dominating the global stock market heat map for July 31st, and man, it tells quite a story. Despite all the recent market turbulence and the anxiety we felt earlier in the month, this data proves for sure that July is closing out with immense, undeniable optimism. I mean, it is a literal sea of green out there. Today, we're going to decode exactly why this is happening.
Here's our quick flight itinerary for today's explainer. First, we'll start with the big picture filled with green. Then we'll check out the US market's cash flow rotation. From there, we fly over to Japan to look at the Nikkei and exchange rate volatility. Next, we head over to where Europe is setting historical peaks. And finally, we'll wrap up by asking what awaits ahead.
All right, let's get right into Section 1, a picture filled with green.
The sheer scale of the global market recovery at the end of this month is just staggering. The main thing you need to take away from this is that an immense wave of optimism has completely washed over global markets. Those previous sell-off fears that had everybody on edge, well, they've been temporarily, if not entirely, overridden. It sets an incredibly bullish tone for the day. And to really understand how we got here, we have to look at the specific indices driving this momentum. That brings us to Section 2, US market cash flow rotation. Because underneath all that green optimism we just talked about, there's actually a pretty fascinating internal battle happening right now in the American markets. Looking at the broader benchmark, the S&P 500 executed what analysts love to call a perfect shakeout midweek. It dropped down and tested a really deep support level at 7,300 points. But instead of breaking down, strong bottom fishing demand stepped right in. Buyers rushed back to the table, driving a massive 2.65% rebound straight up to the 7,500 zone. This perfectly preserved the uptrend and showed a really evenly distributed strength across the market. The money didn't actually leave, it just reorganized itself. To understand that reorganization, we need to define a crucial financial concept that is playing out as we speak: rotation. Basically, rotation is the act of moving capital out of high-risk assets, think your high-flying tech stocks, and strategically parking it into traditional, value, and defensive stocks. We're talking healthcare, financials, industrials. This explains exactly how the cash is flowing through the U.S. economy right now. So the crucial point is how this rotation creates a stark contrast between the major indices. On one hand, you've got the Nasdaq 100, which represents a pretty bruised tech sector. It's high risk, and it's been fighting tooth and nail just to hold on to its critical 27,000 support level. But on the exact opposite side, we have the Dow Jones Industrial Average. This index represents those traditional, highly stable companies. Right now, it is acting like a giant sponge, absorbing all that rotated cash flow fleeing from tech.
The Nasdaq 100 was undoubtedly the most battered index over the past week because of those intense tech sell-offs, but it managed a fierce bounce right off that vital 27,000-point line. It snapped back hard to 28,500, stopping its fall and trying to form a short-term bottom. Keep in mind, though, since it's just a technical recovery right now, we still need a few more trading days to confirm if the cash flow has truly returned to these higher-risk assets.
Now, on the flip side of this rotation is the Dow Jones, currently sitting at roughly $52,208. It is acting as the ultimate market safe haven today. The price structure is accumulating beautifully near its old peak. It's incredibly stable, super attractive to risk-adverse capital, and it's setting up a prime, bullish base for a potential breakout. All right, let's cross the Pacific for Section 3, Nikkei and exchange rate volatility. We're heading over to Japan, where central bank decisions are causing some seriously explosive, volatile growth.
Across the Asia-Pacific markets, the absolute standout star is the Nikkei 225. It jumped a massive 4.03%. Earlier today, it actually surged all the way to 65,500 points before facing a bit of intraday selling pressure. What this massive surge did was completely erase the short-term bearish pattern that had been hanging over Japanese equities. But you might be wondering, why did it happen so suddenly?
Well, there are two distinct macroeconomic drivers behind the surge. First is what we can call the BOJ effect. The Bank of Japan decided to hold interest rates steady at 1.0%. Basically, by doing nothing, they did everything. They totally relieved the market's anxiety of waiting in fear for a rate hike. Second, there was a major foreign exchange intervention. A sudden, sharp drop in the US dollar to Japanese yen pair forced traders to urgently unwind massive currency trades.
To really grasp what happened there, we need to talk about the carry trade. A carry trade is when you borrow money in a currency with low interest rates, like the yen, to invest in higher-yielding assets elsewhere. When that currency pair suddenly drops, traders are forced to close out those positions. Unwinding this carry trade acted like a giant vacuum. It pulled massive amounts of capital from abroad and pumped it directly back into Japanese domestic markets, spreading way beyond just semiconductors and into the entire Japanese index basket.
Let's keep moving to Section 4. Europe sets historical peaks. While the US is rotating and Japan is dealing with currency shockwaves, Europe is quietly the unexpected, undisputed star of our July 31st global tour. Now, what's really interesting here is how different localized catalysts created this unified, totally unstoppable momentum across the entire continent. Over in the UK, the FTSE 100 hit a brand new record high near 11,000. This was fueled by the Bank of England holding interest rates, but doing it with a confident, hawkish tone that injected massive confidence into London's markets. Meanwhile, in Germany, the DAX 40 surged past 25,800, completely shaking off industrial concerns and riding high on global tech earnings from companies like Infineon. And looking at the broader Euro Stoxx 50, it jumped 3% in just 2 days, heavily supported by Q2 GDP data that came in way better than expected. The German DAX surging to 25,814 reveals a European technical structure that is, honestly, virtually flawless right now. If you follow the trend, there are zero signs of weakness, zero signs of distribution. It is a picture of absolute structural dominance.
When an index looks like that, we say it has entered price discovery. This is a super powerful technical state, where an asset breaks past all of its previous resistance levels and enters totally uncharted all-time high territory. It is literally out there searching for a new valuation ceiling. It's this euphoric, barrier-free zone, and it perfectly describes where European indices are operating right now at the close of July.
And that brings us to our final section, Section 5. What awaits ahead? We've covered a ton of ground today, synthesizing some pretty complex movements across 3 major continents. So I want to leave you with this final provocative thought. We have Europe operating flawlessly at all-time highs in full price discovery mode. We've got massive amounts of cash actively rotating into safe haven stalwarts in the US, like the Dow Jones. And we have Japan experiencing wild capital-injecting volatility. Looking at all this interconnected data we just unpacked, is the global market gearing up for the start of a historic unstoppable supercycle? Or is this rotation into safety actually just the calm before a very volatile August storm? Think about how all these interconnected gears turn. Thank you so much for joining me on today's Explainer. Keep your focus sharp out there, and I will see you next time as we continue to decode the markets together.